Breakout trading is one of the most exciting and potentially profitable strategies in trading. Imagine watching a stock, forex pair, or crypto asset struggle to break through a key level. Then suddenly, boom, the price explodes, leaving slower traders behind. That's the essence of breakout trading, spotting critical price levels and capitalizing on strong moves when those levels are breached. But here's the catch. Not all breakouts are created equal. Some lead to massive trends, while others turn into fakeouts that can trap traders. So how do you separate real breakouts from false ones? Let's dive deep into breakout trading, exploring the types, why they happen, and the pros and cons of this strategy. What is breakout trading? Breakout trading is a strategy that involves entering a trade when the price moves beyond a well-defined support or resistance level with increased volume. The idea is simple. When price breaks out, it signals a strong potential for a new trend to start. The market has been stuck in a tight range, testing the same level over and over. Then, out of nowhere, price explodes through resistance. That move isn't random, it's a signal. Or maybe the opposite happens. Support holds strong for days, then suddenly, sellers take control, driving price lower. That breakdown, it's a shift in momentum. The goal is simple. Spot the move before the rest of the market catches on. That's where the real opportunity lies. Types of breakouts. Not all breakouts are the same. They can take different forms, each offering unique trading opportunities. Here are three major types. Continuation breakouts, trend breakouts. A strong trend pauses, consolidates into a pattern like a flag, triangle, or wedge, then resumes in the same direction. What's happening? The market is catching its breath. Traders who missed the earlier move jump in, adding momentum to the breakout. Imagine price grinding higher, then moving sideways for a while, only to suddenly surge to new highs. That's a classic continuation breakout, best for traders who thrive in trending markets. Reversal breakouts. These signal a potential change in direction. The price has been ranging or trending in one direction for a while and then suddenly breaks through a key level, suggesting a reversal. Why does this happen? Market sentiment shifts, often due to economic news, earnings reports, or major technical patterns, like double bottoms or head and shoulders. Example: a forex pair has been stuck in a range for weeks, and then a big breakout above resistance signals the start of an uptrend. Great for traders who like spotting trend reversals early. 3. False breakouts, fakeouts. Not every breakout leads to a trend. Sometimes price breaks out, but instead of continuing in that direction, it quickly reverses and traps traders who entered too early. Why does this happen? Lack of volume. A breakout with weak volume isn't strong enough to sustain a trend. Stop hunting. Market makers push the price past key levels to trigger stop losses before reversing the move. Trap traders. If too many traders jump in too fast, the market might reverse to shake them out. Example: price breaks above a key resistance level, traders rush in, but then it suddenly drops back below, leaving them stuck. Biggest risk in breakout trading, so always wait for confirmation. Why do breakouts happen? Breakouts occur due to shifts in supply and demand. When the price is stuck at a key level, it means buyers and sellers are in balance. But when one side gains control, the price breaks out. Here's why breakouts happen. 1. Increased buying-selling pressure. When price reaches a resistance level multiple times, more buyers may step in, pushing it through. If a support level is tested too often, sellers might overwhelm buyers, leading to a breakdown. 2. News and economic events. Earnings reports, central bank announcements, and geopolitical news can trigger explosive breakouts. Example: a company announces record-breaking profits, causing its stock to break out to new highs. 3. Stop-loss triggers and liquidity zones. Traders set stop-loss orders near key levels. When price hits those levels, stop-losses trigger automatically, creating a chain reaction. Example: a breakout above resistance triggers short covering, where traders who bet against the stock are forced to buy back their positions, pushing prices even higher. Institutional and algorithmic trading. Big players like hedge funds and market makers hunt for liquidity near key breakout levels. They may fake a breakout to lure in retail traders before reversing the move. Pros and cons of breakout trading. Like any strategy, breakout trading has its advantages and risks. Pros: why traders love it. High profit potential. When a breakout works, it can lead to massive moves. Clear entry and exit levels. Breakouts offer well-defined trade setups. Works in any market. Whether it's stocks, forex, crypto, or commodities, breakouts happen everywhere. Great for short-term and long-term trading. You can trade breakouts on intraday charts or use them for long-term investing. Cons. The risks to watch out for. Fakeouts. Getting trapped in a fake breakout can lead to quick losses. High volatility. Sudden breakouts can trigger whipsaws, where price moves violently before settling. Requires discipline and patience. If you enter too early, you risk getting faked out. If you enter too late, you might chase a bad trade. How to trade breakouts effectively. Wait for confirmation. Look for high volume to confirm the breakout. Use indicators like moving averages, RSI, or Bollinger Bands to filter weak breakouts. 2. Use stop losses wisely. Place stop losses just below the breakout level to protect against fakeouts. Avoid placing stop losses too tight. Market makers love stop hunting. 3. Look for retests. After breaking out, price often comes back to retest the breakout level before moving higher. A successful retest confirms strong support and reduces the risk of a fakeout. 4. Follow smart risk management. Never risk more than 1 to 2% of your account on a single trade. Set realistic profit targets using previous highs, lows, and Fibonacci levels. Final thoughts. Should you trade breakouts? Breakout trading is a powerful strategy, but it's not for everyone. It requires patience, risk management, and the ability to spot real breakouts from fake ones. If done correctly, it can lead to huge winning trades while keeping losses small. Want to master breakout trading? Backtest, analyze, and refine your strategy. The more you practice, the better you'll become at catching big market moves before they happen.